But Bryce, before we speak to Tracey, let's unpack the company ourselves. Today we're talking about Lowe's, the discount workwear supplier in Australia.
At Lowe's? No.
No. We are speaking about a much bigger American cousin to Australia's Lowe's.
Yes, a Fortune 50 company.
I actually don't think they're related at all.
No, they're
We
not.
should be clear. But we are talking about the $120 billion hardware giant over in the US.
Yes, listed on the New York Stock Exchange. The ticker is LOW. It is the second largest home improvement retailer, headquartered in North Carolina. Just over 2,000 stores operating in the United States, Canada, and Mexico, serving approximately 20 million customers a week. Almost the entire population of Australia.
True.
Going through their doors.
$97 billion in revenue last year, up from a bit over $96 billion the year before. $6.5 billion in profit, down from $8.5 billion the year before. But still, like, it's a $100 billion a year sales business, valued at $120 billion. Like, it's giant. Conceptually, it's not a difficult company to understand. It's like Bunnings.
That is correct.
I mean, if you're not Australian, that makes it more difficult to understand.
Yes,
Yeah.
conceptually not difficult, but I think as we've learnt from many times on this show this year, having spoken to experts about big box retail and whatnot over in the States, these companies are incredibly tied to a lot of macroeconomic tailwinds or headwinds, whichever way you want to look at it. Particularly as they play out in the States. Slightly different to what's going on here in Australia as well. And that case is certainly the same for Lowe's.
Yeah, so let's talk about some of those headwinds and tailwinds. I think the first one and the biggest one is the US housing market. And the quirk of the US housing market is that you can fix your mortgage. And so what's happened over the last 18 months is a lot of American homeowners got a fixed 30-year mortgage with a 1 or a 2 in front of it. You know, a mortgage with 2%. And then all of a sudden there was a massive run up in interest rates, and all of a sudden selling your house and moving would mean going from a 2% mortgage rate to a 7% mortgage rate. Similarly, refinancing your mortgage to unlock equity that in your home would mean refinancing at a lot higher rate. So all of a sudden, a whole lot of Americans are stuck. And stuck in a good way, stuck paying 2% interest on a mortgage.
Maybe. I was thinking about that though. You're pretty handcuffed.
You're paying 2% interest on a mortgage.
Yeah, but like, you're not going to be at your house for 30 years right now.
I might be if I pay 2%.
I doubt it. Anyway.
I mean, you're right. Like you have to stay in a place for longer because you need to build up more equity, because if you want to move, you want to borrow less so you can afford a 7% repayment.
It's great if you're in a stage of life where it is your final home.
But I also think that, like, the 2% was the anomaly, not the 7%.
Yeah.
So, like, I don't feel too bad that the market's sort of gone back to normal. Yeah.
Well, I don't feel bad for that.
Well, you just said you felt bad for them.
I'm saying you said it's pretty good, and I'm saying I don't think it's as amazing and positive as people make it out to be. Like, oh.
All right, let me ask you this: if you were buying your house that you've bought, if you were buying it 2 years earlier, would you have gone fixed or variable? So if you were buying in 2021,
there would be a high likelihood you'd go fixed, but we don't have a 30-year fixed in Australia.
Yeah, but I'm saying, what would you have done if you could?
2 years ago?
Yeah.
Well, I mean, highly likely it would have been fixed.
So it's a good thing that they have that choice.
Is it a choice, though?
Yeah, I think it's a choice.
But what I'm saying is it's a 30-year lock.
I feel like you're not going to win an argument that a 2% 30-year fixed mortgage is a bad thing. It's a good thing.
Yeah, what I'm saying is that it's going to become problematic at some point for them, is my point.
Anyway, no one is here to listen to us argue mortgage rates. People are here to listen to Tracey talk about Lowe's. So let's keep going. Regardless of whether it's a good or a bad thing, the fact of the matter is it is a thing. And what it means is that a whole lot of American homeowners aren't going to be moving anytime soon because they don't want to subject themselves to higher rates, even though it might be a good thing. So what they're going to do is they're going to renovate. They're going to, if they're growing their family, if they need more space, they're going to add a room, they're going to add a floor, they're going to find ways to do more with the space that they have. And that, in theory, should be good for companies like Home Depot and Lowe's.
The headwinds with that, though, are inflationary pressures, cost of living.
Yeah.
So it'll be interesting to get Tracey's view on how, I guess, both the tailwind and a headwind come together and how that plays into the thesis for Lowe's.
Should we ask Tracey her view on our argument?
I'm sure she'll side with me.
So I think that's probably the key macro trend. And then there are a number of company-specific trends. We're here in Australia and we've got one dominant home improvement retailer, one of the best retailers in the world.
Bunnings, sorry,
yes. America has a couple of big players. Home Depot is probably right up there in terms of like incredibly well-run retailers. I think it's something really notable that the CEO of Floor and Decor is ex-Home Depot. The new CEO, well, a couple of years old, the new CEO of Lowe's, also ex-Home Depot. You just sometimes see that with retailers. Yeah, that like there's just like a lot of great retailers made in this one company and then they go out and do well in other companies.
Yeah.
I think like Walmart has had that
yeah.
in its previous iterations.
They all move around.
Yeah.
When we're at Coles and Woolies, they were flip-flopping all over the place.
Yeah. They say that Coles circa 2016 to 2019 created some generational leaders. So yeah, I think that's interesting that Home Depot seems to be producing CEOs for then some of its biggest competitors. But there is competition in this market, Lowe's and Home Depot being the biggest two, but the market after that is pretty fragmented. So I think there's a lot of small players in the US, which potentially means a lot of opportunity to, either roll them up or outcompete with them on use your scale to get lower prices and the like. So that's what you want to see, I guess, as a retailer, because the name of the game in retail is three things: expand your store footprint, have more stores, improve your sales per square foot, improve your same store comps, and then thirdly, improve your margins in each store. And you do that with, like more private label and stuff like that. If you do those three things well as a retailer, you're pretty good business.
Yeah. I would say fourthly, Ren, before we bring Tracey in, look for strategic partnership opportunities, just like Lowe's did in partnering with Woolworths to launch the infamous Masters brand.
I'm surprised you bring that up.
Well, it's just a fun fact.
So for people who aren't familiar, a black spot in Australian retail history is when supermarket giant Woolworths,
leading supermarket giant,
decided that they would try and rattle Wesfarmers, who owned both Coles and Bunnings, amongst others, and would compete with Bunnings. And so they partnered with Lowe's, 50-50 joint venture, and opened Masters Home Improvement in Australia.
Yeah. Big
box hardware retailer, like a direct Bunnings competitor. How long did it last?
I'm honestly going to say less. I actually don't know. I joined Woolies when it closed. I'm going to say less than 2 years.
I think maybe a bit more, but yeah.
Like
not long.
It wasn't long. It was in and out.
And they lost a fair bit of money on it, and it was it was not a good moment for Woolies.
No.
Yeah. So anyway, Lowe's, that probably doesn't form part of Tracey's investment thesis for Lowe's.
No. A 7-year period. There you go. For that whole thing. Anyway, closed in 11th of December 2016. Well, Ren, that's probably a good point to bring in Tracey to get her view on the bull case and the bear case for Lowe's. So we're here with Tracey Wahlberg. Tracey, welcome to Equity Mates.
Thanks for having me. It's great to be here.
So to kick off, how would you describe Lowe's?
Yeah, so it's the second largest US home improvement retailer. So let's put that into perspective. It has over 1,700 stores in the US. And in 2023, they'll do about just less than 90 billion US in revenue. So it's a decent size, decent scale. They have about 18% market share of the home improvement retailing market. And collectively, Home Depot and Lowe's share less than 50%. So that gives you an indication of kind of how they sit in the market and also how fragmented that long tail is.
I'm excited for this conversation about Lowe's because I think this year we've had an expert speak about Home Depot.
Yeah.
Is it Depot or Depot? Depot, there we go.
The American in the
Testing
room, Depot.
And we've also had an expert come in and talk about Floor and Decor.
Yeah, cool.
Yeah,
It's a good company.
But we haven't spoken about Lowe's yet. So we're
Yeah,
really
let's do it.
covering the big box American retailers here. So when we're looking at a big retailer like Lowe's, what are the metrics that matter for us as investors?
Yeah, it's a good question. So we first start with kind of comps. So that's same store sales comps or comp sales. And that really tells us about the underlying growth rate in the business. We'd point to that as organic growth. Comp sales break down into average ticket and average transaction. So I like looking at these two components when I look at comp sales because ticket tells us something about inflation, but it also tells us how well the retailer is doing to attach other products to the sale or grow basket size. So in Lowe's case, think of it like if someone's DIYing their laundry room and they go and they buy a washer dryer, if Lowe's is able to also sell them the tapware or the sink, the cabinetry, that's captured in ticket. And it can work against a retailer as well. So ticket sizes can decline if someone needs to budget. And so it can also tell us about the health of the consumer. And then on the other side, on transactions, it gives us an indication of volume growth. So how well is the business doing actually getting the inventory out the door? And that also tells us about engagement, customer traffic, and health of the consumer. Another revenue metric that I like looking at is sales per square foot. So this metric tells me about store productivity, and it's great to compare to peers, particularly when you have two big players in the US, Lowe's and Home Depot, against one another. So we can compare how well they've done in store productivity and how much they're able to sell per square foot.
Well, on that point, how do Lowe's and Home Depot compare on some of these metrics that you've just spoken about?
Yeah, so it's an interesting question. So let's go back in time to answer that one. In 2009, so that's kind of, let's call that just post or maybe depths of GFC, right? They were quite close in the head race of sales per square foot. Really only about a $50 differential in sales per square foot between the two of them. So Lowe's had about $250 per square foot back then. They've grown that to $450 per square foot today. Wow. So they've done a great job, but Home Depot has pulled ahead. Okay. And so Depot's over $600 per square foot. So quite a productive retailer.
What have they both done to grow it so much, and why? Like, what's the story
let's
there?
get into that today. So there's a lot of really great trends that underpin the home improvement retailing industry in the U.S. So let's first and foremost start at maybe how Home Depot did it to pull ahead a little bit, and what happened at Lowe's, because Lowe's has really, since 2018, it's become a bit of a transformational story on improved execution by management, improved merchandising and inventory. In fact, they did an investor day at the end of last year, and there's this awesome slide their head of merchandising put up, and it was like what our stores used to look like and what our stores look like today. And it was like out of stocks, end caps weren't placed correctly, products that generally attach to other products weren't nearby one another in the store. And so it was just, they had kind of lost their way. But Lowe's in particular back then also focused heavily on the DIY consumer. And so that's kind of your weekend warrior, as they call them, the people that go and might do up their house on their own, but then also people who are painting a room or, fixing up decor. And that focus on the DIY brought them a lot of private label brands into the store because the DIY consumer was price conscious. Now, compare that to Home Depot. They had a more brand-heavy offering to really appeal to the professional trade. And so their revenue split is more 50-50 pro DIY, where Lowe's is more 25-75 pro DIY. So it's my belief that that focus on the pro, the tradie, as we would say in Australia. I'm not Australian, as you can tell from the accent, so I won't appropriate that term. But the focus on that higher value customer who comes in more frequently and shops more really did them well during that post GFC period. And then there were some other things that were happening post GFC that I think continue going forward, so we can get into that.
So Tracey, let's move to the bull case then, because we've had we're from a retail background. We've had many people come on and pitch various retail businesses, and often the story or the bull case just revolves around how well they can grow their store footprint, and how they can do it, cost effectively. So what makes up the bull case for Lowe's, and what is their competitive advantage?
Yeah, all great questions. And I'd say for a retailer, that's broadly correct, right? It's execution and it's growing your network and maintaining scale advantage. But there's also another piece, I think, in retailing that we look for, and we're particularly interested in finding businesses that are customer obsessed. Retailers have to return value to the customer, and it's paramount once you get to scale that you continue to return that value. But for Lowe's in particular, and Depot, maybe we can start at the industry level metrics in the upside case. There's a lot of kind of structural data points that are underpinning good base demand for this industry in the U.S. So first and foremost, the U.S. is structurally short housing units, so dwellings. And so that's not freestanding homes, it's apartments, it's everything, but it's not dissimilar to Sydney in that sense, right? And so it's underpinned a rise in home prices that hasn't really seen much of a headwind. State-based, there's different regional trends, but overall, housing prices remain really high in the U.S. and underpinned by a structural shortage, but also underpinned by the fact that mortgage rates have just made houses super unaffordable. So also not dissimilar to Sydney, but dissimilar is the fact that Americans can take out a 30-year fixed rate mortgage. How jealous are we? So existing home sales are the lowest they've been since the GFC, and that is a cyclical low. But what that's done is it's actually pulled out a person who would normally tart up their home for sale, right? Because no one's motivated to sell their homes. So you might be thinking, Tracey, then how, we're supposed to be talking the upside case here, so what's going on? Well, the age of housing stock is really old in the U.S., and it might not sound old to Sydney-siders who live in kind of terraces that were built pre-1900, but median age of houses in the U.S. is over 40 years. And let's go back to kind of 1990s, that was more like mid-20s year old. And so your forced incidence of maintenance and repair is much higher now. So that underpins a kind of base demand. And the amount of money you have to spend when it's forced maintenance and repair is often higher as well. It's non-discretionary. You need to fix your roof. You've got to replace the water heater, etc. And then there's some other interesting demand drivers around, like energy efficiency upgrades. So we know Americans have spent more on energy efficiency upgrades over the last 2 decades. There was a housing survey that was recently published that put it at over $100 billion on energy efficiency upgrades spent in 2021.
Wow. Oh, wow.
And that compares to less than $60 billion in 2005. So there's a growth rate there, and it's underwriting another healthy sign of demand. I don't think that's set to slow, given the Inflation Reduction Act has fiscally incentivized that to continue. And Lowe's is very focused on that activity. And then also kind of related to climate change is the fact that natural disasters are continuing at an increasing pace. So the size of U.S. billion-dollar events, so that is a natural disaster that impacts infrastructure at a cost of $1 billion or more. The number of those has risen. About 5 happened per annum in the early 2000s, and recently it's about 25.
Whoa.
Wow.
So there are these really nice structural trends that are underpinning demand for home improvement retailing in the industry. And then with Lowe's in particular, they've started to focus more on that professional trade. And so they've brought back the brands pros like. They brought back in a more regional merchandising activity that is necessary when, let's think about it as like the plumber who goes to your house, needs a part, pops out to a retailer to grab that part. Well, if the part that Lowe's sells in that metropolitan area isn't up to code for those homes in that area, right? The tradie can't buy it there, he or she, and so goes somewhere else. But then you immediately lose trust with that person, right? So bringing them back in is a slow process. So they've been working on this strategy since Marvin Ellison came to the business in 2018. And they've done a pretty good job. They've grown pro mix from 19% to 25%. And so we really want to see that continue. So in conclusion, the upside case takes us to sales per square foot of over $500. So continues that trend of top line growth. And then they generate nice operating leverage on that. So operating profit margins would expand about 100 basis points to 14.5%. And then they can continue that growth past that. It kind of put that at maybe the next 5 years they get there. And I think that's reasonable. And that really isn't in expectations at the moment.
Yeah. I love that, this massive retailer, and there's like a very specific thesis that you have around there's a lot of industry the tailwinds going on, but for you there's a specific business strategy that they're trying to execute, and if they can execute that, that will impact the one key metric you're looking at, and that'll flow down to the bottom line. It's an important reminder that, like, when you have your thesis, the metrics that you have to watch and that become really important sort of narrow.
Yeah, that's right.
Yeah, I guess the question that I have thinking about your thesis, though, is there are all these tailwinds for the home improvement industry more generally, and improving the pro-am mix, I guess, the improves revenue per square foot, better margins, better profit.
Yeah.
You said Home Depot is also focused on the pros, and they're maybe a little bit ahead of that journey, but it sounds like they're still focused on that category. So why Lowe's over Home Depot?
Coming back to that execution piece, I think that idiosyncratic kind of company-specific risk is really attractive to us. The fact that first Marvin Ellison came from Home Depot. So he left Depot understanding the pro strategy and had a journey in retailing, and then came to Lowe's. But he brought with him people who were former Depot executives back in their time. And they've also just laid down a lot of infrastructure and groundwork, upgrading their technology, and they made kind of a 30-year leap in their technology. So there's a lot of idiosyncratic elements that we like about Lowe's relative to Home Depot. But, like, make no mistake, Home Depot has done an incredible job. They have very attractive returns, and they will participate in the same kind of industry structural tailwinds. The thing, though, I would say is Home Depot has a pro strategy that, while it's worked, it's mature. And so then Lowe's is able to, if executing well, grow 2x the pro market. So that gives us exposure to a little bit more kind of shareholder value accretion, if you will. The free cash flow growth rate should be a little bit higher at Lowe's if everything works out. And Home Depot are now going after a growth strategy that is with a more complex job and a more complex pro. So they have to invest behind this strategy. Undoubtedly, the return profile, I would suggest, looks good. Depot's very good at thinking through IRRs before they allocate capital. So it's not growth for growth's sake necessarily, but it is a different occasion. It's a different customer, and it's a different selling strategy. That selling strategy also comes at thinner margins because it's harder to differentiate yourself when you're selling, large lots of timber and gyprock versus more branded goods and smaller parts. So I think for me, it feels like we get a nice growth rate longer term with Lowe's. Valuation is also very compelling relative. And so we have this really nice margin of safety that we feel we've found in that business.
So, Tracey, let's turn to the bear case. What are some of the metrics you'll be looking for, or some of the red flags that you'll be keeping an eye on?
Yeah, so there's a bit of a bear narrative brewing in the market at the moment, and I think that's really what's giving us that nice opportunity to buy structural growth at a reasonable price. But, okay, so let's break this into short-term, long-term. And we really focus on the long-term at Magellan, so I don't want to get too caught up in the short-term, but the short term, certainly the DIY customer faces pressure. They have chewed through a lot of their savings that they accumulated from government handouts during the pandemic. Interest rates are really high, credit's expensive. So they're not able to access really attractive kind of home equity amounts that they've built up. In fact, Lowe's estimate the average Lowe's customer has about $350,000 of home equity. In aggregate, the U.S. is sitting on over $30 trillion in home equity, right? But if mortgage rates are upwards of 7.5%, 8%, like they were kind of peaked in October 2023, you aren't refinancing your mortgage to take advantage of that when your mortgage rate is sitting at 3.5%, right? So that is certainly putting pressure on those bigger ticket discretionary items, things like changing all of the flooring in your home or doing the kitchen and the bathrooms at the same time. You're doing them in smaller job lots. So we're seeing this commentary not only come through on the DIY side, but also on the pro side. Pros backlogs, while healthy, they're down year on year, and they're filling with smaller projects. So duration becomes the biggest short-term risk. How long does this last? And then how much of a headwind does that put on comp sales next year? Comp sales in 2023 will probably end around down 5% for Lowe's. So do they face another negative comp sales environment? And then what's operating deleverage like at the profit line? So that's the short term. In the long term, the downside scenario for me would really be execution risk around growing sales per square foot. I need to see them execute on that better productivity plan that they have in place. And it's not just cost productivity. I don't want to see them strip out an enormous amount of costs. Often, businesses will do that short term, but then they sacrifice the long-term value creation opportunity. What I've liked about the current management is that they've really invested well in not only merchandising and that strategy, but also, as I mentioned before, the technology platforms and upgrading technology, but they've also taken the time to change the cultural perception of what it means to be a Lowe's associate and sell to your customer. So they're creating that frontline culture that hopefully resonates with the customer and creates customer obsession. That's starting to come through in customer service scores. And so we're seeing that trend positively. If we should see that go backwards at all, I think that's your kind of initial red flag. The customer is your kind of canary in the coal mine. So watching that customer obsession metric is really important.
It's such a reminder just how important management is always important in any business, but there's a particular type of person that you need to run a retail business, a real retailer, someone who is obsessed with customers but obsessed with merchandising and will walk the shop floor and face up items and just has that just crazy level of attention to detail. You mentioned that a lot of this turnaround happened when this ex-Home Depot guy
CEO Marvin,
he came across. How much is the thesis tied to him and his team in particular? If he was to move on, would you be rethinking about this company in a different way?
So the initial answer is yes. And so then I follow that up with, it's not key man risk in that sense, but it is an element of he has created the strategy with his team. They are executing on it, and we need that inertia and momentum to continue in order for them to really meet that long-term target. It's highly disruptive as well for businesses to go through executive change on a frequent basis, and I would say from 2018 to today would still be considered frequent to me. I want to see Marvin there for a long time. I want to see, Bill Boltz, who runs their merchandising strategy. I want to see him there for a long time as well. As long as everything's going well and they continue to get along with the other executives and they can create a happy ship culture, stay there forever. If there's turnover in executive management, it's something that we don't take lightly. We really look into the reasons why, and that could be a signal that the wheels are falling off.
So, Tracey, to close out, we always like to look to the future. Beyond the 5 years, let's look to the 10. What do you, if they are able to execute on their strategy and and things pan out the way that they expect, what do you hope to see Lowe's to be in 10 years' time?
Yeah, certainly they could get to that over $600 per square foot level that Home Depot has already achieved. I think that's entirely within reach, so perhaps they could even exceed that. Their omni-channel strategy, I would hope, has crushed it at that point, and it's not 10% of sales, but maybe it's upwards of 30, 40% of sales. They can't deliver everything, but they've certainly shown they can deliver a lot. And so if they can continue doing that, it just further improves productivity. I'd also love to see in 10 years, I don't want to talk about a competitor, but if you talk to, let's say, a Tractor Supply, I don't know if your listeners know this company, but Tractor Supply is a great retailer in regional U.S., and they have created a customer who is highly obsessed with their business and kind of just goes there and chills out and talks about chickens and chicken feed and horses and horse feed, right? I'd love to see Lowe's in 10 years have this tradie, professional, or even semi-DIY pro kind of mix customer who just hangs out in store and is so obsessed with what Lowe's retails and the innovation that they bring to the store and the way they kind of think at the forefront with their customer experience. I think that, to me, plus a great membership model, would just make this moat that's very difficult to compete with.
Love that.
Nice.
Well, we've done an episode on Tractor Supply this year, as well as
Okay,
Floor and Decor
great.
and Home Depot. So we'll include those 3 episodes in the show notes. So if people just want to go really deep on US big box retail,
Excellent.
they can.
Excellent.
One thing that we haven't really touched on, but you said it at the start of the interview, so I figure it's worth just touching on it as we close off. Between Home Depot and Lowe's, they're a bit less than half the market.
Yeah, that's right.
And we've spoken about the thesis and we've spoken about the risk to the thesis, but we haven't spoken about any consolidation of the smaller hardware stores in the US.
Yeah, so that remains an opportunity. The reason I haven't discussed it, it remains an opportunity that I think is kind of there for the taking, but it doesn't have to be central to make the thesis work. It's not necessarily what's in the price. Execution can be something that they can continue to do by growing share of the pro, and that's not necessarily away from their smaller competitors like Ace Hardware or Menards. But there is a long tail of independent retailers still in the home improvement industry that they can go after. And they should be able to. Their size and scale kind of allow for that competitive advantage.
Yeah. I think, again, just a reminder that, the thesis that you laid out is specific, and there's some specific metrics that you're watching, and there's a specific plan that the management team are trying to execute on, and, it helps you sort of narrow the focus as an investor, and you don't have to be watching everything, and, not everything has to go right to be a great investment.
Yeah, that's right. I think this is an industry where rising tides could lift a lot of boats. So it doesn't have to be an industry consolidation opportunity for them to generate that growth. And we really love that. We love when we can find companies that have multiple pillars or multiple drivers behind potential forecasts. We're flawed and erred as humans in our ability to forecast. And so if we have multiple sources of potential growth drivers, it just helps us get some conviction in the outlook.
Love it.
Well, Tracey, thank you so much for coming on. Thoroughly
My pleasure.
enjoyed the conversation, and we appreciate your time.
Thank you. Thanks very much.